The global economy is a vast, intricate web, constantly in motion. At its heart lies international finance, the system governing the flow of money across borders. Understanding this complex domain is crucial for comprehending global economic stability and growth. International finance encompasses all financial transactions between countries. It involves the exchange of currencies, the movement of capital, and the financing of trade and investment. This interconnectedness shapes economies worldwide. At the core of international finance are several fundamental concepts. These principles dictate how money moves and how nations interact economically. Grasping them is essential for navigating the global financial landscape. Exchange rates are the price of one currency in terms of another. They determine how much foreign goods and services cost and how competitive a nation's exports are. Fluctuations in these rates significantly impact trade and investment flows. Many factors influence exchange rates, including interest rates, inflation, political stability, and economic performance. Central banks often intervene to manage their currency's value, aiming for stability and economic advantage. The balance of payments is a comprehensive record of all economic transactions between a country and the rest of the world over a specific period. It provides a detailed snapshot of a nation's international financial position. It comprises two main accounts, the current account and the capital and financial account. The current account tracks trade in goods and services, income, and transfers. The capital and financial account records investment flows. A current account surplus indicates a country is exporting more than it imports, or receiving more income from abroad. A deficit suggests the opposite, often requiring foreign borrowing or investment to finance. International trade involves the exchange of goods and services across national borders. It is a primary driver of economic growth, allowing countries to specialize and benefit from comparative advantages. Exports are goods and services sold to other countries, bringing in foreign currency. Imports are goods and services purchased from abroad, requiring the outflow of domestic currency. The balance between these defines a nation's trade position. Trade surpluses occur when exports exceed imports, while deficits arise when imports are greater. These balances have significant implications for a country's economic health and its currency's value. Foreign investment represents capital flows from one country into another. It takes two primary forms: foreign direct investment and portfolio investment. Both play vital roles in global capital allocation. Foreign direct investment, or FDI, involves establishing lasting control or a significant stake in a foreign business. This often includes building new facilities or acquiring existing companies, fostering long-term economic ties. Portfolio investment, conversely, involves purchasing financial assets like stocks and bonds in foreign markets. Investors seek returns without gaining direct control over the foreign entity. It is generally more liquid and short-term. The intricate dance of international finance involves a diverse cast of participants. Each plays a distinct role in shaping the flow of capital and the stability of the global financial system. Their actions ripple across economies. Central banks are pivotal in managing a nation's monetary policy and maintaining financial stability. They influence interest rates, control money supply, and often manage foreign exchange reserves. Governments establish fiscal policies, regulate financial markets, and negotiate international trade agreements. Their decisions directly impact a country's attractiveness for foreign investment and its economic standing. Organizations like the International Monetary Fund, the World Bank, and the World Trade Organization provide crucial frameworks. They foster cooperation, offer financial assistance, and set rules for global commerce. The IMF promotes global monetary cooperation and financial stability. The World Bank provides financial and technical assistance to developing countries. The WTO facilitates international trade by reducing barriers. Multinational corporations operate in multiple countries, driving significant cross-border investment and trade. Their global strategies influence capital flows, technology transfer, and employment patterns worldwide. These corporations often leverage international financial markets to fund their operations and expansion. Their investment decisions can profoundly impact the economies of both host and home countries. Individual investors also contribute to global money flows through their investments in foreign stocks, bonds, and real estate. Their collective decisions, though smaller individually, can influence market trends. Access to global markets allows individuals to diversify their portfolios and seek higher returns. This participation further integrates national economies into the broader international financial system. While international finance offers immense opportunities, it also presents significant challenges. Navigating these complexities requires careful management and robust policy frameworks. Currency volatility poses a constant risk, impacting the value of international transactions and investments. Sudden shifts can erode profits or increase costs for businesses and investors alike. Financial crises, often originating in one region, can quickly spread globally due to interconnectedness. These events highlight the need for strong regulatory oversight and international cooperation. Geopolitical risks, such as trade wars or political instability, can disrupt global supply chains and deter foreign investment. These non-economic factors significantly influence financial flows. Regulatory differences across countries create complexities for businesses operating internationally. Harmonizing standards and understanding diverse legal frameworks are ongoing challenges. Despite the risks, international finance offers substantial benefits. It facilitates economic growth by enabling countries to access capital, technology, and markets beyond their borders. Diversification is a key advantage for investors, allowing them to spread risk across different economies and asset classes. This can lead to more stable and potentially higher returns over time. Access to capital markets abroad provides companies with more funding options for expansion and innovation. This fuels job creation and technological advancement, benefiting entire economies. International finance fosters innovation by promoting competition and the exchange of ideas. It encourages efficiency and the adoption of best practices across industries worldwide. Understanding international finance is more critical than ever in our increasingly globalized world. The flow of money across borders shapes economies, influences policies, and impacts daily lives. The intricate web of exchange rates, trade balances, and investment flows defines our shared economic destiny. As technology advances and economies become even more intertwined, this understanding will only deepen in importance.